Good evening, everyone. If you can just make sure that you're muted here in the beginning, we're going to give it a couple more minutes here and then we'll go ahead and get started. All right, so why don't we go ahead and get started this evening? Tonight we're going to be talking about college bound. So when we think of college planning, we kind of put it into two different categories, and we have two different seminars that we've done on that. One is ways to save to get you to college and hopefully have some money to be able to pay for the college. Tonight's seminar is really about kind of all of the things you do in the last year or two before you're off to college. So we call this one our college bound seminar. And so hopefully we've got some good information here for you this evening. All right, so I'm Dave Nieder, president of Sterling Financial Management. It's been pretty important to us to try and provide some education opportunities for our clients. And so hopefully you folks are finding some good information here that we're able to share with clients. So we have with us tonight, Allie Serbaugh. She is our marketing director. And so tomorrow or next day here shortly, we're going to be sending out a survey. We'd appreciate some feedback on that, ways that we can make this more relevant. Any type of feedback, we always encourage that. Also, please check our website, the content there. We're updating pretty frequently, and Allie does a fabulous job with that. Also, you can find us on Facebook, so we would appreciate a like and a follow on Facebook and also on LinkedIn. So we have a lot of content that we're putting out, our different advisors on all of those different media fronts. So kind of some other areas we're going to touch on this year and later on into this year: Social Security, long-term care in June, Medicare planning, estate planning, and then we'll have kind of a mid-year outlook update. I think usually we do that kind of early September-ish kind of a time frame. So by then, maybe we'll know whether this forecasted recession is actually here or maybe it's moving on. So stay tuned to our mid-year outlook. So of course, one of the things is we don't want to just head to college without any planning. So of course, we want to make sure that we're prepared and have thought through some of the things we're going to be dealing with in college. So I know one of the first things you think about when your kids are getting ready for college is somebody else going to pay for it? So I know we're all interested in financial aid. So what is the college that may be expected to kick in? Is there any scholarship opportunities? What is the school going to help pay for? So I know financial aid is a really, really important question that that we all kind of go through. Where's the money coming from? So now a lot of folks just think, well, I make too much, and so I definitely wouldn't qualify for aid. And that isn't necessarily true. So some schools you may end up getting more aid from than others. And so we'll kind of talk about that. So one of the areas that we really need to understand is as a merit-based aid and or a need-based aid. So we're going to talk more about that later on, kind of what that means. But I mean, definitely income plays into that, and so we'll take a look at those different areas. So one of the key figures that is kind of a starting place, would recommend that you start here, is what they call an expected financial contribution, an EFC. So this really is a number that we can arrive at, and it just, the number is, in simple terms, what you would expect or what you're expected to pay for that college. So we've had a lot of our clients go through that, and usually the feedback we're getting from clients is, you're expecting me to pay what for college? That much for college? So there's no way I can be able to pay that number. So unfortunately, I think college planning for me has been a very frustrating part of the financial planning process. Number one, because it's so expensive, and secondly, it's a severe financial burden, on our clients. So it unfortunately is one of those areas that I cringe in talking to clients about. So so on this slide, this really begins to help you to understand kind of where that expected financial contribution comes from. So if we start kind of on the left-hand side there, and we see how the EFC is calculated, one of the first determining factors that we look at is the income. So from a parent's income, really this is where a lot of that EFC is going to come from, in a range of 22 to maybe 47%. So a lot of clients think, well, man, if I'm not going to get any aid, then, what's the use in trying to save anything? Or, you feel kind of frustrated in that way. But really, the amount of assets that you have saved for college has the lowest impact overall on your expected financial contribution. So only about 5%, call it 6 maybe as an average. So 6% of what you save goes into that expected financial contribution. Probably one of the best things that we've been able to help clients kind of think through is what your child has in their name. So unfortunately, if a child is working and making a lot of income, there is kind of an income threshold that would begin to factor into that calculation. So depending on what the child makes, so you can see there that the figure is $6,500 a year. So as a child makes more than $6,500 a year, about 50% of whatever they make above that threshold begins to be counted towards that expected financial contribution. And then the other determining factor is the assets in your child's name, 20% of their assets. So really kind of the key takeaway that we have here is, obviously we want to make as much as we can in income. So we're obviously we want that to be as high as possible, but it's important to really try and make sure that we've got that savings there. And then if at all possible, use the child's money first to help pay for the college and or minimize the amount of money that are in the child's name. So really, if you take the cost of college and you subtract from it, so that's the formula up above. So if you look at the total college cost each year and you subtract your expected financial contribution, to some degree, the difference between those two would be an expected financial aid eligibility or possibly some type of help from the school in helping to pay for that college. So we've got some EFC, on this slide right here, lower left-hand corner. So you can start at the U.S. Department of Education. So if you want to learn more about that EFC and maybe a quick little calculator, that's a place to go to for kind of determining your EFC, or kind of getting an idea of what that is. So what this slide is trying to help you to understand is if you look at the assets on the top part of that slide, so, if I have 0 assets saved, or maybe I've got 25,000 saved, or 50 or 100, 150, what would that do to my EFC calculation? So let's say we have 100,000 in income and I've got 50,000 saved for college. My EFC would be 18,000. Well, if I have 50 more thousand in the bank, my EFC only went up by another $3,000. But if you look at going from 100,000 of income to 125, you can see where that's got an $8,000 impact on your EFC. So key takeaway is just income probably affects your EFC much more than savings. So if anything, obviously putting away money for college is definitely an important thing and something to focus in on. So this here kind of first introduces, so when you look at kind of the FAFSA and the aid application and how you begin to apply for colleges, there's really two different formulas and two different ways that colleges are going to use your financial information to determine your aid package. So one of them is just called the federal EFC, and the other ones is the institutional EFC. So the one generates off of what's called the FAFSA, and the other one is a CSS profile. So kind of the, and call the college. So as you begin your search, they will tell you kind of which one they will take. And so the CSS can have a few little wrinkles in it that's different than the FAFSA. But so you call the institution and ask them. A lot of the private colleges, went through that or use that CSS profile. So Allie, do you want to chime in a little bit here? I think you've had a couple of the CSS.
Yes. So my daughter's a senior in high school, and we have already completed the FAFSA, and she had one private school she was applying to that required the CSS profile. If you do not have to complete the CSS profile, do not complete it. It is much more involved and much more complicated than the FAFSA. So I have friends whose kids, were not going to any private or weren't interested in applying to any private school, so they didn't have to worry about it. And so I recommend checking first before you take the time to fill it out, because it will take a while.
Yeah, CSS, a lot more in depth.
Yes, it asks a lot more income questions. It probably, I'd say the FAFSA took us less than an hour, and the CSS profile took us maybe closer to 2.5 to 3 hours. Just because we didn't realize how many more pieces were needed. And so we were kind of trying to find paperwork around the house to fill it out.
Yeah. So I think our seminar here probably downplays the differences between them. It really only points out a couple of different other questions, but so the reality, as Allie found, CSS definitely took a bit more. All right, so here's so we just kind of go through some examples. Again, key takeaway is lower income, cash investments, fewer impacts on that EFC. But we have a profile here: 2 parents, one college freshman, and a younger sister, 55,000 in combined income, 15 grand in investments. The expected financial contribution, 2,500, CSS methodology, 2,400. So as you'd expect with that level of income, a lot more need-based aid would be and much lower EFC. So again, how do we determine what the demonstrated need is? So cost of college minus your EFC is a demonstrated financial need. So, you can kind of use that figure to go back to the college with and see if there's more that they can do with you. So I think the other thing to take away from this, and if the suggestion is, the earlier you start, the better off you are. So some folks put off, doing the FAFSA, but really the earlier you do that and get your information out there. Some colleges have a pool of dollars that they're going to give away in aid. And so if you're later on, there could be a possibility that pool could have been used up, on an earlier basis there. Here's a profile, 150,000 of income, 120,000 of investments, 250,000 of home of equity in your home. So I want to make sure we clarify home equity. Some of us think of that like, well, I've got a home equity line of credit, like I've borrowed from my home. So this truly is equity in your home. So that would be the difference between your fair market value and what you owe. And so you'll notice a little bit of a difference here between the FAFSA and the CSS profile. So that equity in the home is brought into that equation a little bit more. So the estimated contribution a little bit higher in that regard. So the other kind of key takeaway here is the more children you have in school, your expected financial contribution is going to go down. So we'll see another slide on that later on. I'm not sure how, as a parent, again, we're talking about college bound, those that are getting ready for school. I don't know how you use this in your family planning. Does that mean you have children as quickly and as fast as possible early on? So I'm not sure what we're supposed to use with this, or maybe the cost of college is so high that maybe we space them out 6 or 7 years in between. But so EFC does drop with more than one college, more than one child in college. So as you can see from the slide here, if this is, is fairly accurate, but 2 students, your EFC is going to go down pretty significantly, having multiple kids in colleges. All right, so as we mentioned, there's really, I think one of the key differences as you begin to look for colleges is to really kind of weed out those colleges that provide more need-based aid as opposed to merit-based aid. So a merit-based aid is you have a very bright student that is very academically inclined. So there are schools that will hand out a lot more merit-based aid than an actual need-based aid. So there are some ways to kind of determine that, and we've got some ways that you can go through and begin to whittle those things down. But that definitely is a key difference. I think you need to kind of hone in on is need-based versus merit-based aid. We've got a slide later on here that I think we'll come back to that. Your EFC should be on your financial aid letter. So once you apply for college, you're going to get back an award letter. So, if you kind of look, and I apologize, kind of a small print on this, but, one of the first things that you look at is truly what is the discount? What are we getting from the school? And in some cases, the schools will put on your financial award letter loans. Well, in my mind, a loan is not an aid. A loan is something that I got to repay back, right? So to me, that's not an aid. But so if you look on this award letter, there's a Parent Plus loan, there's a direct unsubsidized loan. So one is earning interest while you're in school, the other one is not. And so when you look at that, that helps you to kind of determine what your cash payment to the school will end up being versus maybe what you can borrow and then what you're getting in aid. And then the EFC should be on the bottom. So if it's not on the bottom of that award, then you can contact the school and ask them kind of what your EFC is. In this little example here, the expected financial contribution was 0 and college cost was 60, and it's kind of small print, but I think the student would still owe around 20,000 more dollars. So if you've got an EFC of 0, you would really expect almost all of the college to be paid for. So again, just kind of a way for you to determine, what kind of aid letter and awards, that what you've gotten from the school itself. So sources of financial aid, of course, the federal government has some aid available. In some cases, the state, Pennsylvania, I know my kids went through Pennsylvania. There were some aid-based grants and things that they were able to qualify for. Colleges, some cases some nonprofit or private, banks, credit unions, of course, other lenders for loan purposes. So, and it kind of seems like this this whole program in this last year and a half, 2 years has been changing dramatically. Of course, when Biden introduced some possibility of some loan forgiveness, even some of the Sally Mae and some of those programs, just in severe stress, and so seems to be kind of a changing landscape, unfortunately, here in this last couple of years regarding that. But again, a key takeaway, and I know this is college bound, but putting away dollars, if anything, is really, really important. And of course, having money to spend for college, putting it away is an important part. So some of the FAFSA formula to understand is, so there's some things that the FAFSA we don't have to include. So within the FAFSA and the EFC, your expected financial contribution, that will ignore retirement accounts and annuities. So essentially something that's deferred. So life insurance cash value is not included. Also, family-owned business with less than 100 workers is also excluded. So you may want to check out that article. I think it's still a valid link there, but kind of walks through that FAFSA. And again, the CSS profile does exclude or possibly can bring back in things like retirement accounts and stuff like that. But so just understand the key differences between them. FAFSA does not count equity. The CSS does. However, vacation homes, rentals, some things like that may come into play. I know we get a lot of questions surrounding divorce situations, but one of the key factors here, and it gets kind of confusing for clients. I know some, we hear things like, well, did I claim them on my taxes, or is my ex claiming them, or where are they going to fall? But really the key determining factor is what we call the custodial parent. And so the FAFSA definition of a custodial parent is the parent that the child resided with for the majority of the time. So what's not relevant in that is, who claims the child on the taxes or who pays the child support. So also stepchildren can count in that. So if maybe a custodial parent is providing for the support, then you can, whether they're actually in your home or not. So that custodial is a really important determining factor in who to claim and what to claim on your FAFSA. So here's kind of some of the differences in that CSS profile. As we mentioned, home equity, net worth, sometimes non-qualified annuities, and cash value gets brought back into that profile. So in the CSS example, we mentioned that assets only really about 5% apply. So that equity though could increase your EFC by maybe up to $10,000. So, again, there are some key differences in that CSS profile that are a little different than the FAFSA. Divorce is also treated a little bit differently. So I don't know, kind of a key difference between the CSS and the FAFSA is the CSS is going to bring more information in, more assets, and probably come up with a higher expected contribution than overall than the FAFSA. So divorce sometimes asks for both parents, both spouses' income coming into play there. So here's kind of so we found this as a little in a tabular format here, some of the differences between the FAFSA and the CSS. And as I mentioned, you folks are going to get this from Allie, or if you need that, if you need that, definitely check in with Allie, and she will send you the slides and everything else. Make sure you get that. So all this will be coming to you in an email format. So how about aid? What all do aid kind of things take into? What does the formula bring into that? Well, of course, we're going to look at the taxable investments that you have, child assets, and then of course college accounts. One of the key determining factors in those college accounts is the owner. Who is the owner? So I think we have in here UPMA accounts. So usually, your child is born, first birthday, everybody gives them, you have their first birthday, everybody gives them gifts and cash. And so you've got all this money, and what do? You go down to the bank, you go to deposit it. I would like to, put this into Johnny's name. We've got a nice bouncing boy. He's now a year old. We've got all this money that we just got from his birthday. What should we do with it? Well, we open a custodial account. So you as the parent are going to watch over the money for the kid until he becomes of age, and then it becomes their money. It's an irrevocable, technically considered gift, and you are responsible for managing that. So in those UPMA and UGMA types of situations, it's considered the child's asset. So 529 plans are a little bit different in that you may be the owner, the child may be the beneficiary. You can change those beneficiaries, but really the key difference is who is the owner. So if that's something that you don't know, something important to kind of make sure you work through and figure out, because as we mentioned, savings accounts in parents' names is treated much differently than savings in the child's name. And just again, kind of hitting home here, savings don't hurt you quite as much as other things that are out there. The other thing to kind of understand is that there's also what's called kind of a protection allowance. So think of it in this way. It means that money that I have saved in my name or me and my spouse's names, there's a protection allowance. So up to that threshold, within that protection allowance, it's kind of an excluded asset. So if I'm 44 years old, two parents, essentially the first 6,000 of savings is excluded from that EFC calculation. So, so this kind of walks through that exclusion. Here's a couple that have $8,000 saved for client. They're 57 years old, maybe a little bit older on the scale. So none of those assets are counted for that EFC calculation. So, and again, the CSS profile, about 5% of parents' assets are considered. So key takeaway, we've kind of hit on this before, teenagers' assets. If the year you go to file for financial aid, make sure the child doesn't have any money in the bank. You know, in some cases, we've had parents who will go out and the day before they fill out the FAFSA form, they'll withdraw all the kids' money and they'll file the FAFSA form, and then they'll redeposit that back to that bank account. So it truly, the FAFSA is a date. It is a date-based application. So you are answering the questions on the date that you are filling out that application. So, you know, so any, you know, make sure your kids don't have any money for college in their name. Key kind of takeaway there. So, all right, impact of student assets. You know, we kind of mentioned 20% of that and 25% of the CSS. So it counts, definitely counts against them. The other crazy thing is, you know, you think it'd be a great thing for kids to go out and work and, you know, make money for college and all of that. And so, you know, whatever, it's just one of those things that just is what it is. But kids making more than 7,000 of income, that income does come into play for factoring in the FAFSA formula. So I don't know, maybe tell your kids to make the first 7,000, and after that, don't make any more money over 7,000 because it impacts your aid. So we kind of mentioned custodial accounts there. We hit that on that earlier slide. So UGMA accounts are just a standard way of you're the custodian watching over the kid's money, but technically it's the child's money. Also, you can have custodial 529s. So a 529 just means it's a special investment account where the growth on it can be potentially tax-free if it's used for college. But you can have, so let's say you started with a savings account and then you're like, well, I'd like to begin to put this into a college fund. So then you open a 529. The money that's transferred from the savings account to the custodial 529 is still considered the child's assets. The other thing that we've kind of run into, or a lot of folks have some questions. So again, how are we going to pay for college? So if your grandparents have the ability to help you with that, and this is going to be changing, I believe, for the 24-25 tax year, or for FAFSA year for those college years. But as of now, there is a spot on the FAFSA that says, did anyone else outside of your home help to pay for some of that college? So potentially grandparents essentially paying for some of that college costs could impact some of your aid and some of the what you may get from the school itself. So some planning methodology around that is maybe wait until the final 2 years of college, because by then, you know, the FAFSA is based on the previous year's financial information. So the other thing that can happen is grandparents can gift to a parent. And again, parent assets not counted quite as much. So there is some planning around that, maybe taking out more loans. So, you know, always around, you know, there's always a couple of different ways to get there. But you know, those are kind of some planning ideas around grandparents. Okay, so we kind of talked about financial aid and where that comes from. Of course, tax returns, your income, non-retirement assets. So we talked about the number of children in college, kids' assets and income, and then of course grandparents contributing to college can all have impacts on aid and things. So how do you boost your financial aid or maximize your eligibility? You know, unfortunately, there's not a lot that we can do to kind of change that. one of the things that you know, that we would suggest is really just cast a wide net. Understand how the different schools are giving out their scholarships and their aid. I think that's really, you know, and also kind of what we call it casting a wide net. Maybe look at schools, and we'll have some examples kind of coming up. But so some of the things we can kind of do on the margin is understand, you know, when we're going to be filling out that FAFSA, and then the types of things that maybe would you know, hurt you, bonuses, or maybe taking distributions from plans, converting, you know, your custodial accounts into the 529s, triggering, you know, maybe you're selling stock or something like that. So anything that's going to really increase that FAFSA questions are things you really need to kind of pay attention for. The other thing, now this slide's a little bit older, but one of the things that you also need to understand is that, you know, when you fill out the FAFSA, you're usually filling out. So this year you would be filling out your FAFSA for October, in October of 2023. But really that information, and that the information that you're filling out, then the 2023 FAFSA is really based on the 2022 tax year, and it's for your 2024 and 25 school year. So understanding that, you know, when you're filling things out, what the FAFSA is asking for is kind of a key way of you know, helping to understand, you know, what you're filling out and what things may impact your financial aid. Another kind of a thing here is maybe minimizing capital gains. You know, a lot of times, let's say we bought Apple stock, you know, 10 years ago for the child, and now we're ready to sell that. When you sell that, could be a potential for some income. And, you know, again, is there ways we can do some tax planning around that? We talked about being strategic when filing the financial aid forms. So, you know, if it's possible, you know, maybe withdrawing things before you fill out the actual form, and then, you know, maybe redepositing that or something like that. So, you know, we talked about spending the child's money first. So maybe before they get ready for college, maybe you're going to buy some things that are going to help them for college, put that away, you know, maybe buy all of their dorm room supplies or something like that, getting rid of the child's money first. We kind of hit on this earlier, you know, applying for aid early. You know, that can help to increase the possibility of aid. And so really it is best to you know, to get that out of the way as early as possible. You know, I know when I sat down and kind of talked about this with my son, so I have three boys, and so my one son was like, well, I'm just going to be independent. I don't have to, you know, you don't have to pay for anything anymore, and then I'll get all my aid. Well, unfortunately, it's very extremely difficult for a student to truly be considered independent. So about the only way that really kind of gets through that is if you're married or 24 years or older. So it's kind of difficult to for kids to be considered independent. Okay, so we've got a couple of slides in here, I think, just kind of talking about just kind of some of the different tax impacts, some loan types of things. There is what's called an American Opportunity Tax Credit. So, you know, you figured out what your EFC is, you've applied for college, you've gotten your financial aid. So now you've begun to pay for some college costs. One of the things that the government gives you is what's called a tax credit. So up to $2,500 tax credit per child. Now, unfortunately, that is a phase out. So if you make as a single person more than 80,000, or as a joint couple more than 160, that unfortunately could be phased out. But there is that track tax credit that is available. And there's a little wrinkle in this that says that you can't double dip. So let's say $2,500 of cost, you've taken that as a credit and a deduction. Well, then when you go to withdraw your 529, you can't use those same expenses to offset the 529 plan. So to be honest with you, I have not on my taxes figured that out to the nth degree. I assume when I hand my stuff in to my accountant that they're figuring it out in a good way. And I don't know how in the world the government ever keeps track of all of this stuff or keeps it all straight on the 1040. But technically you can't double dip in that way. Okay, so this is, so we kind of talked about college costs, and we talked about being strategic, figuring out, maybe casting a wider net. What college would we want to go to? One of the things that you're able to do is it's called the net price calculator, but it essentially is just a way for you to kind of figure out what that college is going to cost. So all colleges have that on their website, and here may be a way that you may want to use that. So here's two different schools, both technology. Drexel, of course, probably very well known. Here's the New Jersey Institute of Technology. One's significantly less than the other. So is there any difference in the school? Drexel, you can make 71,000. New Jersey Institute, you can make 71,000. So beyond having Drexel on the name, essentially casting a wider net may have given you, a much lower cost of college than maybe one that's a little more well-known. So, and kind of a rough rule of thumb is the usually the schools with the best need-based aid are often the larger, more elite schools. So if you think about it, anybody that has money or can pay to go for schools probably may be able to afford some of those more elite types of schools. But also, if you think of the schools can advertise, hey, we're bringing in, folks that really need the aid and need that help to be able to get into our institution. So unfortunately, a lot of the larger, more elite schools don't give out very much merit-based aid, but maybe a little bit more not very much merit-based aid, but more need-based aid. So throw that wide net, get out there, encourage your kids to really check around. This College Board site, I have not been able to play around this very much, but you can go in and enter your profile into that. And there are some searches that you can do on that College Board. But, and Allie, I don't know if you want to mention anything here for folks on, maybe what some of the sites are that you found beneficial, and not to put you on the spot there. I don't know if anything comes to mind directly, but did you find maybe this College Board that helpful? Or?
Yes, we did use College Board, but we did find that some of the schools are not listed on College Board. And so you had to go to the school's own website to find out the like their net price calculator. And some of the schools also with the EFC, because you can kind of figure that out with the net price calculator on the school site. And some of the schools just had much more detailed information than others. So we kind of wondered, if it only asked a couple of questions, how accurate it was going to be.
Yeah. I mean, intuitively, it kind of makes sense to me. I mean, I've a number of folks in my Rotary Club all went to Juniata, and they all make fun of one of our retired guys that's going to Rotary Club about being from Juniata. But I think some of the smaller schools and even maybe some of the state schools, Juniata being Pennsylvania, I think they give out a little bit more merit-based aid. So it kind of intuitively makes sense as you think of, where kids can potentially end up. They might need to give more merit-based aid to attract those brighter students, as opposed to, some of the larger schools giving out a lot more need-based aid. So, but, a question you could ask maybe the financial aid office. So we went through some of these grant programs. There is the Pell Grant. So a Pell Grant is a number that you qualify for, and it truly is a grant, so that does not have to be paid. So we list some of the other grants that are available on here, and unfortunately, this Pell Grant is impacted by your EFC. So the larger your EFC, probably the lower that Pell Grant is that you're going to get. So if we don't qualify for any types of grants and things, where are the dollars coming from? Well, you may have to go out and get some loans. So there's what they call subsidized and then some unsubsidized loan. And so basically it's just when that interest begins to kick in. And then, so there's those two types, direct plus. So the Stafford loans really are loans in the student's name. And then we get into basically loans that are on the parental side of things. So, ultimately who ends up paying for those loans doesn't necessarily matter. So if you, the parents, say, hey, you're going to borrow it, son, daughter, but I will help pay for them. But technically there is a child loan or a college loan for the kids, and then loans for the parents. So there's a direct plus and then there's a graduate type of program. So theoretically, you can borrow as much as you need for college, and you can get that. But, of course, you got to make sure you can pay for that. So this is a website here that I found, or excuse me, some resources we found, some different places where you can go to get some information, on the program. So with that, I kind of blew through this tonight, talked really fast, hopefully, and I think having access to the sites or the slides and things. With that, we can open this up to questions. So you're welcome to unmute yourself, and if you have questions, we can definitely take some questions here before we conclude for the evening. So. And Allie, was there anything else you thought may be helpful to maybe chip in here?
I think going back through these slides, so I will send those out tomorrow. I think going back through them for me was very helpful because it is a lot of information. And so the more I read it, it helped me to understand things, in terms of completing the FAFSA and the CSS profile, and then just trying to evaluate schools based on how much they're going to cost. Because until you start getting award letters, you're not really sure how much things are going to cost. Because sometimes you can find like a number, out there, but it may not be the most accurate. So it was helpful for us to do the EFC so we could kind of figure out what we were expected to pay. So as we were looking at schools and seeing how much they cost.
Yeah, and one of the things I think why we, some of the private institutions, you look them up online and it's like $60,000 for college. And then you look at a state school at $28,000. But a lot of that cost, the $60,000 at the private institution, ends up coming down through a lot more merit-based aid. So, I know a couple of my children ended up at Cal U, And we really didn't get a whole lot of aid to kind of offset that. So, so don't let sometimes that sticker shock, if you will, don't let that kind of scare you away. Definitely there's some opportunity there that probably some of the private institutions, have some dollars to be able to give you. So.
Yes, I was gonna say, we did notice that because there was a school my daughter had applied to that was a private school, and I think the sticker price was 70,000. But they were gonna give her enough scholarships to bring it down to 45. So if that was still a little more than we wanted to pay, but it definitely, to go from 70 to 45, that definitely makes a big difference.
Yeah. Okay. Yep. So if we don't have any questions, we'll go ahead and conclude this evening. And if you do have some, by all means, definitely shoot us an email. We can look into that for you, contact your financial advisor, and we can definitely help you. So with that, I hope everyone has a great evening to that. And so we will talk to you later.